Many people claim Social Security early and regret it later. I've been helping couples build retirement plans for over 15 years, and I can tell you that the decision to claim Social Security early is almost always a fear-based decision, not a decision that's based on strategy. Claiming your benefits early can potentially reduce your lifetime income benefits from Social Security by tens of thousands of dollars. This is not even taking into consideration the joint or the spousal benefits that you may be eligible for. Remember, Social Security is not just about what you receive today. It's more important to consider the amounts that you'll be receiving 20 plus years from today, where you have to factor in what other income sources you're going to be receiving at that time and the impact that inflation is going to have on your standard of living. Claiming early at 62 can result in a 25 to 30% reduction in your overall benefit when you compare that amount versus what you would receive at your full retirement age. Deferring your benefit to age 70, however, can result in you receiving an extra 8% deferred benefit credit or an 8% increase in your overall benefit for each year that you defer beyond your full retirement age. This could result in your benefit being 76% larger if you waited to 70 versus claiming at age 62. Many people want to know about the break-even age, and for individuals, the break-even age usually lands around your late 70s or early 80s. This means that if you live longer than that, you would begin to collect more benefits if you had delayed. One of the biggest mistakes I see people making when it comes to the break-even age is if you're married, your largest benefit is actually going to last 2 lifetimes because the largest worker benefit for the household is also the survivor's benefit that remains once we lose a spouse. So if you're factoring in break-even ages, you have to consider the survivor benefit and how long that benefit will last as well. The biggest mistake that I see couples making when it comes to Social Security is not coordinating benefits. If you are married, you have potentially 2 to 3 different types of benefits that you have to think about. So having a coordination strategy between spouses is going to be huge if you're trying to build out an optimal claiming strategy for your overall Social Security benefits. Not only should you consider your workers' benefits, which are the benefits that each of you could claim on your work history, you also want to consider the spousal benefit and the survivor's benefit. Let's look at an example. And this is an example that anyone can follow because we're going to use an example directly from the Social Security website. We're going to use the Social Security statement of Wanda Worker. If you look at her statement, Wanda can claim her benefits as early as age 62. At 62, Wanda can receive $1,465 per month. Also, if you look at Wanda's statement, you'll see that Wanda has the ability to defer her worker benefit and claim at any age beyond 62. If she defers all the way to age 70, her benefit is significantly higher. Wanda's benefit at age 70 is $2,634 a month. Now, here is a critical thing that everybody needs to understand about these Social Security statements. When you look at these numbers, these are projections, right? Social Security does not factor in cost of living adjustments in your statement because they can't. Those cost of living adjustments are announced every single year. So when you look at these numbers, they are static. What I can tell you is that if Wanda were to go ahead and claim her benefit early at age 62, that's the benefit she's going to receive, and all of her cost of living adjustments will be applied to that benefit. However, Wanda is also eligible at age 62 to receive those cost of living adjustments if she doesn't take that benefit. So for every year that she defers, not only is she going to receive a higher benefit because the Social Security payment will be higher, She will also be receiving cost of living adjustments added to those benefits that Social Security does not put on these statements. So if you're looking at claiming at 62 versus 70, you have to factor in inflation will make that benefit higher at 70, and you're not going to see that on your statement. I did some quick math, and over 25 years using a 1.5% inflation adjustment, here were the amounts. Wanda, if she claims at 62, Wanda would receive $528,507. If Wanda waited to 70, she would receive $616,020. That's $87,513 more in benefits. However, I just told you that Wanda did not receive any inflation adjustments on her benefit. So we have to factor in the account that Wanda's paycheck starting at 70 could be significantly higher. So let's consider, not only are we receiving those delayed retirement credits on the Social Security paycheck for deferring, we also need to consider inflation. Again, it's super important that everyone understands when you're looking at your worker statement or your Social Security benefit statement, Social Security does not factor in cost of living adjustments on those numbers. So a couple of things you want to make sure that you fully understand. One, take a look at the earnings that they're counting. Do you have any years where you feel like the earnings are incorrect, or you are missing earnings where you know you were employed? That is something you want to make sure gets corrected. The second thing, if you're going to do any type of analysis on your own, you want to make sure that you're using reasonable cost of living adjustments, because Social Security is not going to do that for you. Yes, Social Security can be taxed, but for some retirees, it's possible to minimize or even avoid tax on your benefits altogether. According to the law today, up to 85% of your Social Security benefits can be taxable. But with strategic planning, it may be possible to reduce or avoid that tax altogether. To determine tax on your Social Security benefits, the IRS uses a calculation that begins with something referred to as your provisional income. The IRS uses a formula that takes half of your Social Security benefits and combines it with all of your other income sources. Some things that they may exclude are qualified distributions from HSAs, qualified Roth IRA distributions, and potentially some cash value life insurance. One of the things that they do include is interest from tax-free or municipal bonds. So be careful when you're looking at your overall provisional income so that you understand how that calculation gets made. Once they have your provisional income, they then run it through some tax brackets. Now, warning, these tax brackets have not been updated in decades, and they are very low. If you're a single filer, the first hurdle begins at just $25,000 of provisional income. If you're a married filing joint, the first tax bracket hurdle begins at just $32,000 of provisional income. In my opinion, these brackets are artificially low, but they are what they are. Understanding them will help you make better decisions on how to claim and structure your Social Security as part of your income plan. Strategic income planning will definitely help. Having tax diversification and dollars in accounts like HSAs and Roth IRAs are going to be massive when it comes to creating tax-free income streams in retirement. You can use HSAs for qualified medical expenses, and Roth IRAs, as long as you follow the rules, those distributions will also be tax-free. Roth IRAs are also unique in that while you're living, there are no required minimum distributions, so no money will be forced out of those accounts while you're still living. In addition to having Roth IRAs and HSAs, proper sequencing of other accounts and having structured or strategic withdrawal strategies to keep your taxes low can also massively impact the way that your Social Security benefits can be taxed over time. The last thing that you can consider is having a tax-efficient asset allocation. It's not just what you own, but where you own your assets that's also going to matter. So if you've got IRAs and Roth IRAs and brokerage accounts and savings and checking accounts and CDs, you might want to look where all of your money is and how all of the income being generated is flowing through to your 1040. And then seek to create a tax-efficient asset allocation. The good news for all of us that live in the Carolinas, North Carolina and South Carolina do not tax your Social Security benefits. So that's one thing we don't have to worry about right now, is that neither state calculates taxation on Social Security checks. This gives us a meaningful edge against lots of other states. A key takeaway if you're looking to understand how your Social Security benefits are going to be taxed is, first, you need to understand how your provisional income is going to be calculated and how that may change over time. Then you need to understand how that provisional income is going to run through those brackets to determine the right amount of Social Security to count toward your overall taxes. Now, if you're worried about Social Security disappearing, here's the real story. Even if funding challenges force Social Security benefits to be reduced in the future, Social Security isn't going away. But relying too heavily on Social Security income without having a backup plan can make your retirement income vulnerable in the future. According to the most recent Social Security Trustees report, absent any changes to the program, they are expecting the trust fund that funds benefits to be completely exhausted by 2023. If this trust fund is depleted, it will automatically trigger a 19% reduction in benefits. That sounds terrible. In my opinion, different generations are going to feel the impacts of Social Security and potential Social Security changes in different ways. Older retirees, people that are on the program and they're heavily relying on these benefits, I don't expect them to see much of a change at all. As you know, political pressure can make it very difficult to make any changes in Washington, D.C., especially if we're talking about major programs like Medicare, Medicaid, or Social Security. In my opinion, I think younger workers are going to see the following challenges. One, I think we're going to see our full retirement age go up from age 67 to an older age. I don't know what that will be, but I fully expect the full retirement age to be increased. I also think cost of living adjustments. I don't know entirely what Washington, D.C. will fix on this, but there's been a talk of playing with the inflation adjustments to the benefits, but I would expect us to have just lower inflation adjustments moving forward in the program. In addition, I think we're going to see benefit changes or formula changes on how they calculate benefits. It would not surprise me at all if someone doesn't introduce means testing to Social Security, where people who are going to have a really high provisional income during their retirement years may see some means testing on their benefits where the amount of benefit they receive gets phased out. The real kicker for the younger generation is I expect to see someone propose higher payroll taxes. Currently, Social Security is funded by payroll taxes where half is paid by the employer, the other half is paid by the employee. I do expect at least a proposal. That doesn't mean it will pass, but I fully expect someone to propose higher payroll taxes, and obviously the younger generations are going to bear the weight of that. Social Security is important, and making a good claiming strategy should be a high priority for any retirement income plan. But it's only one piece of the plan. Social Security should be part of your income floor in retirement, but it should not be your entire foundation. When you're building a retirement income plan, consider all of your potential sources for income. 401ks, IRAs, Roth IRAs. Withdrawals from those accounts can help supplement your income that you need for a lifestyle. Do you need to consider some type of annuity or income annuity that's going to add to or increase your floor of income in retirement? And lastly, retirement is a long time frame to consider, right? Your average retirement could be 20 to 30 plus years. So would there be opportunities for you to do part-time work, consulting, participate in business ownership? Do you have rental income? All of these income sources or ways to generate other income should be considered when you're building a retirement income plan. When it comes to Social Security and thinking about how future changes could impact your overall plan or impact your overall income, Give yourself a stress test. Run a what if scenario. Hey, what if I only had 75% of my Social Security income? How is my plan affected then? What would we do to fill that gap? Feeling unsure about what to do regarding your own Social Security? We help couples in the Carolinas build and create retirement income plans. Click on the link below to schedule a call with our team. Have you already claimed Social Security or are you still deciding? I'd love to know what you're thinking. Let me know in the comments below.